Hello, everyone. I'm glad to present my research paper on the annual Roosevelt Student Research Symposium 2020, which is called Trading and Alternative Investment Management Strategies Momentum. The paper was done by Eugene Kravchenko with the help of my mentor and associate professor of finance, Justin M. Scher. So how and why it all started? It wasn't supposed to be an alternative investment paper at all, as we began just to create a quantitative analysis feedback for our peers, which have participated in the Chicago Mercantile Exchange. But as we have started to dig deeper, it became clear that there is much more than can be done with quantitative analysis. As trading involves different strategies and tactics, we decided to write a code in our programming language, which would allow us to test some of those strategies with the historical data. The purpose of our paper is to answer the question, is there a way to tactically allocate my money? But let's not rush and begin step by step by what trading actually is. Trading is simply the act of buying and selling the asset. It can be a financial security like stocks, bond, a financial ownership of country or government financial debt, or physical, tangible asset like commodities. Why do people trade? People don't just simply trade to make profit. People trade to produce returns and manage risk. In other words, to get better risk-adjusted returns. The trade can only be conducted when both parties are in agreement, where one side is ready to buy and the other side is ready to sell. In terms of mechanics of trading, there are two types of trading, so-called trend or momentum trading and mean reversion trading. Trend trading is the belief that the price is moving in the overall direction. In other words, if it was already going up, we believe that it will continue to go this way. And if it was already going down, we would assume that it will continue to go down. In the chart below, we see an example of price momentum or trend. So let's say the market is here right now. The trend, which is a black arrow, is going up. So we would assume that the market will go up, thus we'll buy. Likewise, the mean reversion is the idea that prices fluctuate around the trend, and if values deviate far from the trend, they will reverse and get back to the trend. In the example here, let's say the market is here, which is very far from the trend, we would assume that it will go back to the trend. So we will likely sell and bet that market will go down. For our research project, we decided to create and run a trend or so-called momentum trading simulation based on the simple moving average, short CMA, with the historical data for the last 20 years. To do that, we would use a quantstrat package, which would allow us to complete a quantitative strategy backtest. What is a backtest, you might ask? Backtest create a set of rules for entry, buy, and exit. Sell the market for a predefined portfolio or just a single stock, and then applies these rules to historical prices to analyze performance of the strategy. The first and very important step of our research project is to download the historical data from Bloomberg. For our research project, we decided to test the S&P 500 futures stock. Once we have data loaded, we begin to create an environmental setup for our backtest. Computers can't think for themselves, as we need to tell them what to do. There are some basic steps that we do to initialize our portfolio. At the beginning, we need to set the time frame for our backtest. As you can see from the code below, it says from 2003 until today. The sys date stays for today. So every time we run the program, the data will be updated every time we do that. We also need to define the trade size and initial equity. Then we will define the names for our strategy and remove any existing ones. Next step is to initialize the portfolio, the account, and the orders, and also to store the strategy. The command get symbols allows us to get symbols from the date that we have set. After the initial setup of our environment, where we load the required data, we need to add indicators. Indicators are very helpful to filter data from noise and get a clearer picture of asset price movement. In our example, we will use a trend indicator. Particularly, we will examine the 200 days and 50 days simple moving averages. The example below from our code, we are adding an indicator with an add indicator command to our strategy. Add the simple moving average function and create a look back period for 200 days, and of course label it as SMA 200. What is simple moving average? Simple moving average is an average of past end days of closing prices. On the picture of the code, we created 200 days moving average with closing prices of SPY. At the beginning, we plot all closing prices of SPY for our time frame, and then we had a 200-day moving average that we have just created, which shows as a red line. So as you can see on the chart here, we had 200 days moving average with red line. Next step, after we calculated our indicators, is to add signals. Signals are interactions of indicators with market data. They're used to determine when we buy and when we sell our predefined assets. In our example, we will buy when simple moving average of 50 days is above simple moving average of 200 days, and sell likewise. Particularly, we will use sig comparison, which is a signal that continuously compares two different quantities and returns one if the relationship is true. Sig crossover returns one on the first occurrence of the relationship changing from false to true. And sig formula combines two or more signals to form ensemble signals. On the example below, we had a sig comparison, which specifies that simple moving average of 50 days should be greater than 200 days simple moving average. We indicate our interest in the relationship between SMA 50 and SMA 200 as GT, which stands for greater than. And then we call it a long filter. The next step would be to add rules. Rules are important functions specifying how we will proceed with our transactions based on our signals. There are two types of rules: entry, buy shares, and exit, sell shares. Here is an example from our code where we are creating an entry rule of 1 share when all conditions are met. Finally, we are able to plot the final chart. With the code below, we are able to create a chart of our trading strategy backtest. By looking at the chart, we can notice green arrows right here, which stands for entering the market, for buying, and red arrows, which stand for selling, exiting the market. As we can see from the code, the simple moving average of 50 days is defined with a blue line. We can see the blue line on the chart. And the simple moving average of 200 days is defined as a red line. We can also see that on our chart. Finally, we compute the Sharpe ratio and apply the T function to get statistical results. Here are some important statistical indicators such as Sharpe ratio, gross profits, percentage of positive and negative trades, and profit factor. As we can see from the stats below, the annualized Sharpe ratio is 0.48. Our strategy backtest gave us 70% of positive trades and 30% of negative trades. and the profit factor is 8.7, which is a very good result and shows that our strategy is successful with the current stock. For our project, we're also able to run a backtest trading simulation for the gold, but our future plan is to be able to prepare more strategies for students participating in Chicago Mercantile Exchange and test them with different asset classes. Also, we would like to implement some more advanced trading indicators and determine how the results will be different. There is still a lot to be done, but with the initial code ready, I believe that our goal is more than achievable. Here are some references for my project. And thank you so much for your attention. I really appreciate it. And if you have any questions, I would love to answer them, as you can leave your comments under this video. And take care.